Have you ever heard of an investment that promises to pay you interest forever? Perpetual bonds are a fascinating financial instrument that offers a unique opportunity for investors seeking a stable income stream without a fixed maturity date. But are they too good to be true? Let's find out. Welcome, my name is John, and in this video, we're going to delve into the world of perpetual bonds. I'll explain how these bonds work, why they might be an appealing option for your investment portfolio, and the potential risks and rewards involved. Stick around until the end, as I'll also provide you with valuable insights on whether or not you should consider investing in perpetual bonds. Let's start by understanding what perpetual bonds are and how they operate in the realm of finance. Perpetual bonds, also known as perpetual securities or perpetuals, represent a distinctive category of bonds that defy the conventional notion of maturity dates. Unlike traditional bonds that come with a fixed maturity period, perpetual bonds lack a specific date for the repayment of the principal amount to bondholders. Instead, these instruments offer investors a perpetual stream of interest payments, ensuring a continuous and stable source of income. This unconventional feature sets perpetual bonds apart from their counterparts and makes them an intriguing option for income-seeking investors looking to diversify their investment portfolios. By delving deeper into the definition and basic concept of perpetual bonds, we can grasp their unique characteristics and understand how they operate in the realm of finance. Perpetual bonds boast several key features that make them a compelling investment option for investors seeking stable income and long-term financial security. Understanding these distinctive characteristics is essential for evaluating the potential benefits and risks associated with investing in perpetual bonds. One defining feature of perpetual bonds is that they lack a specific maturity date. Unlike conventional bonds with a predetermined maturity period, perpetual bonds offer investors the opportunity to receive interest payments indefinitely. This perpetual nature provides investors with a sense of security and predictability in terms of income flow, with no fixed deadline for the repayment of the principal amount. What's more, many perpetual bonds come with a call option, allowing the issuer to redeem the bonds at a predetermined price within a certain period. The presence of a call option provides flexibility for the issuer to manage debt obligations efficiently. From an investor's perspective, the call option introduces an element of uncertainty, as the issuer may choose to redeem the bonds earlier than expected, impacting the potential returns for investors. Perpetual bonds typically offer a fixed interest rate, ensuring a stable and predictable income stream for bondholders. The fixed rate feature appeals to conservative investors who prioritize consistent returns over high-risk investments. However, it's essential to consider the impact of inflation and interest rate fluctuations on the real value of fixed interest payments over time. Unlike traditional bonds that require the repayment of the principal amount at maturity, perpetual bonds do not involve principal repayment. This unique characteristic makes perpetual bonds truly perpetual in nature, offering investors the potential for long-term income without the obligation of principal repayment. For issuers, the absence of principal repayment reduces financial burden and allows them to allocate resources effectively. Lastly, perpetual bonds provide investors with a continuous stream of income through regular interest payments. The perpetual nature of these bonds offers the potential for sustained income over an extended period, making them an attractive option for income-seeking investors looking for a reliable cash flow. Understanding these key features of perpetual bonds is crucial for investors considering adding them to their investment portfolios. While perpetual bonds offer unique benefits, it's essential to assess the associated risks and conduct thorough research before making investment decisions in this asset class. To fully understand the role of perpetual bonds in shaping the financial landscape, let's take a look at the historical evolution of perpetual bonds. Perpetual bonds can be traced back to the 18th century, when governments and corporations sought innovative ways to finance their operations and projects. One notable example is the British government's introduction of perpetual bonds, also known as consols, during the Napoleonic Wars in the early 19th century. These bonds, with no maturity date, provided a reliable source of funding for the British government's war efforts and garnered significant investor interest due to their stable and perpetual income feature. The evolution of perpetual bonds continued as governments, banks, and institutions worldwide adopted this versatile financial instrument for raising capital and managing debt. Notable examples of perpetual bond issuances have demonstrated the widespread use and appeal of these instruments in financial markets. For instance, Singapore's Temasek Holdings, a state-owned investment company, issued perpetual bonds worth 500 million Singaporean dollars in 2019 to support its investment activities and enhance its financial position. Similarly, the Bank of China made headlines in 2014 by issuing additional Tier 1 perpetual bonds worth 1.4 billion US dollars. Civilian US dollars. These bonds were structured to bolster the bank's capital base and financial resilience, showcasing the global demand for perpetual bonds as a strategic capital raising tool. The historical significance of perpetual bonds highlights their enduring appeal and utility in diverse financial contexts, from supporting government initiatives during times of conflict to strengthening corporate balance sheets in modern markets. Perpetual bonds have proven to be a resilient and adaptable financial instrument with a rich heritage of innovation and value creation. Now, let's jump into the various benefits of investing in perpetual bonds and why they are an attractive option for investors seeking stable income and diversification in their investment portfolios. For starters, perpetual bonds provide investors with a reliable and continuous stream of income through regular interest payments. This steady cash flow is particularly appealing to income-seeking investors looking for predictable returns over an extended period. Including perpetual bonds in an investment portfolio can also help diversify risk and reduce reliance on traditional fixed income securities. The perpetual nature of these bonds offers a unique asset class to complement other investments and enhance portfolio diversification. What's more, perpetual bonds offer issuers the flexibility to manage their capital structure and meet their financing needs. By issuing perpetual bonds, companies and institutions can optimize their debt profile and allocate resources efficiently, enhancing financial flexibility and strategic planning. Since perpetual bonds do not have a maturity date, they may offer potential capital appreciation if market conditions favor the issuer. Investors can benefit from a steady income stream and the possibility of capital appreciation over time, adding value to their investment portfolio. Also, perpetual bonds are well suited for investors with a long-term investment horizon seeking to generate consistent income over an extended period. The perpetual nature of these bonds aligns with a buy and hold investment strategy, allowing investors to benefit from sustained income without the pressure of principal repayment. Finally, perpetual bonds serve as a risk mitigation tool in a diversified investment portfolio. The stable income stream and potential capital appreciation can help offset risks associated with market volatility and economic uncertainties, providing a cushion during adverse market conditions. While perpetual bonds offer a range of benefits, they also come with risks and drawbacks that investors need to consider before adding these instruments to their portfolios. For instance, perpetual bonds are susceptible to interest rate risk, as changes in market interest rates can impact the value of the bonds in the secondary market. In a rising interest rate environment, existing perpetual bonds with fixed interest rates may become less attractive to investors compared to new issuances offering higher yields, leading to a decline in bond prices. Additionally, the presence of a call option in perpetual bonds introduces the risk of early principal repayment by the issuer. If the issuer chooses to exercise the call option and redeem the bonds earlier than investors anticipate, it can disrupt the expected income stream and potentially limit investors' returns. Moreover, perpetual bonds with fixed interest rates are exposed to inflation risk, as rising inflation can erode the real value of future interest payments. Investors holding perpetual bonds may experience a decrease in purchasing power if inflation outpaces the fixed interest rate offered by the bonds. Like any fixed income security, perpetual bonds carry credit risk associated with the issuer's ability to meet interest payments and repay the principal amount. Investors must assess the creditworthiness of the issuer to gauge the risk of default and potential loss of investment capital. Perpetual bonds may also face liquidity risk, particularly during times of market stress and economic uncertainty. The secondary market for perpetual bonds may exhibit limited liquidity, making it challenging for investors to buy or sell bonds at favorable prices when needed. Lastly, perpetual bonds are influenced by overall market conditions, including economic factors, interest rate movements, and investor sentiment. Fluctuations in market conditions can impact the performance of perpetual bonds and introduce volatility into investors' portfolios. Acknowledging these risks and drawbacks of investing in perpetual bonds can help investors adopt risk management strategies and diversification techniques to mitigate potential downsides. Conducting thorough due diligence, monitoring market conditions, and staying informed about the credit quality of issuers are essential practices for navigating the complexities of perpetual bond investments and safeguarding investment capital in the long run. Now, let's turn to the market dynamics of perpetual bonds and the various factors that affect them. Understanding these dynamics is crucial for determining pricing, yield levels, trading activity, and shaping investment decisions and portfolio strategies for market participants. Firstly, the market for perpetual bonds features a diverse range of issuers, including governments, corporations, financial institutions, and supranational organizations. These entities leverage perpetual bonds as a strategic funding tool to raise capital, optimize their debt structure, and support their long-term financial objectives. The variety of issuers in the perpetual bond market offers investors a broad spectrum of investment opportunities across different sectors and regions. The growing popularity of perpetual bonds stems from investor demand for stable income, portfolio diversification, and long-term investment options. Income-seeking investors, pension funds, insurance companies, and institutional investors are among the key participants driving the demand for perpetual bonds as they search for reliable returns and risk mitigation strategies. The appeal of perpetual bonds lies in their perpetual income feature, potential capital appreciation, and alignment with a buy-and-hold investment approach. On top of this, the market for perpetual bonds operates within the broader fixed income securities market and is influenced by factors such as interest rates, credit spreads, market liquidity, and investor sentiment. Market dynamics play a significant role in determining pricing, yield levels, and trading activity for perpetual bonds, shaping investment decisions and portfolio strategies for market participants. Regulatory frameworks and guidelines governing perpetual bonds vary across jurisdictions and financial markets. Issuers and investors must adhere to regulatory requirements related to issuance, disclosure, trading, and reporting of perpetual bonds to ensure compliance and transparency in the market. Regulatory oversight aims to safeguard investor interests, promote market integrity, and maintain stability in the perpetual bond market. The market for perpetual bonds continues to witness innovation in structuring and enhancements, with issuers introducing new features, terms, and instruments to cater to evolving investor preferences and market demands. Structured perpetual bonds, hybrid securities, and sustainability-linked bonds are among the innovative products that contribute to the diversity and dynamism of the perpetual bond market. By staying informed about the market dynamics of perpetual bonds, issuer profiles, investor demand, regulatory landscape, and product innovations, investors can navigate opportunities and challenges effectively. Optimize the potential benefits offered by this growing asset class. Before we conclude, it's worthwhile to explore how economic conditions shape the performance dynamics of the perpetual bond market. The interplay of macroeconomic factors, market trends, and investor sentiment influences the demand, pricing, risk profile, and overall performance of perpetual bonds. Understanding the impact of economic conditions on perpetual bonds is essential for investors looking to navigate this unique investment landscape effectively. Firstly, changes in interest rates have a profound impact on perpetual bonds, as these instruments are sensitive to shifts in prevailing interest rates. In a rising interest rate environment, existing perpetual bonds with fixed interest rates may become less attractive to investors compared to new issuances offering higher yields. This can lead to a decline in the market value of existing perpetual bonds and affect investor demand. Additionally, Perpetual bonds with fixed interest rates are exposed to inflation risk, as rising inflation can erode the real value of future interest payments. Investors holding perpetual bonds may experience a decrease in purchasing power if inflation outpaces the fixed interest rate offered by the bonds. Monitoring inflation expectations and their impact on real returns from perpetual bonds is crucial for assessing the risk-return profile of these instruments in different economic scenarios. Economic conditions can also influence investor sentiment and risk appetite, affecting the demand for perpetual bonds in the market. During periods of economic uncertainty and market volatility, investors may seek safe haven assets and stable income sources, making perpetual bonds an attractive investment option. Conversely, in times of economic expansion and optimism, investors may favor higher risk assets over fixed income securities like perpetual bonds, leading to shifts in market dynamics and pricing. Finally, the financial health and creditworthiness of perpetual bond issuers are paramount considerations for investors, especially during challenging economic conditions. Economic downturns, industry disruptions, and geopolitical events can impact the credit quality of issuers, raising concerns about default risk and the ability to meet interest payments. Assessing the credit risk of perpetual bond issuers and monitoring their financial stability in changing economic environments is essential for managing risk exposure and protecting investment capital. By analyzing the impact of economic conditions on perpetual bonds and staying attuned to macroeconomic trends, interest rate movements, inflation expectations, market sentiment, and issuer credit profiles, investors can make informed decisions, adjust their investment strategies, and navigate the perpetual bond market with resilience and foresight. As we wrap up this exploration into the world of perpetual bonds, I have a question for you. Would you consider adding perpetual bonds to your investment portfolio and why? Share your thoughts in the comments below. I'd love to hear your perspective. For more free and practical information on investing, financial planning, and wealth management, be sure to check out the link in the video description. Dive deeper into the world of finance and empower yourself with valuable insights to make informed investment decisions. If you found this video informative and engaging, don't forget to hit the like button and subscribe to our channel for more insightful content on money matters, investing strategies, and financial literacy. Thank you for watching, and until next time, happy investing.